48.34 USD is the number flashing in red across every terminal, every mobile screen, and every trading desk right now. Nutanix Inc., ticker symbol NTNX, has not just stumbled, it is absolutely cratered intraday, shedding $10.43 per share to trade down a staggering 17.75% at this very moment. If you are watching the charts, it looks less like a standard correction and more like a cliff dive, wiping out months of gains in a single trading session. The expectation coming into today was that Nutanix would be the undisputed king of the hybrid cloud jungle, the one company perfectly positioned to catch the billions of dollars fleeing the chaotic Broadcom-VMware merger. The reality, however, has delivered a cold, hard slap to the face of that narrative. The market expected a victory lap. What it got was a warning flare about revenue timing and guidance cuts that have sent investors scrambling for the exit. But here is where you need to pause, take a sip of your coffee, and look closer. Because while the street is panicking over a guidance cut, the underlying machinery of this company might be more intact than this violent sell-off suggests. The gap between the market's hysterical reaction today and the operational reality of Nutanix's business is where the real money is usually made or lost, and we are going to tear apart the situation piece by piece to see if this is a falling knife or the sale of the year. To understand the gravity of this move, you have to look at the sheer velocity of the selling. This isn't a slow bleed, it is a capitulation. Volume is exploding, running nearly 3 times the average daily average, which tells us this isn't just retail traders on the Robinhood app getting spooked. This is institutional rotation. When you see a stock like Tesla stock or Nvidia stock move 5% or 6%, it makes headlines. But a nearly 18% drop in a software infrastructure company like Nutanix signals a fundamental repricing of risk. The catalyst is the Q1 fiscal 2026 earnings report released late yesterday. On paper, the numbers weren't catastrophic. They posted non-GAAP earnings per share of 41 cents, which actually matched expectations. But in the world of high-growth tech, meeting earnings while missing on revenue is a cardinal sin. Revenue came in at $670.6 million, missing the consensus of roughly $676 million. A $6 million miss on a $500 million quarter sounds like a rounding error, something you might shrug off if you are managing your own Schwab Intelligent portfolios. But in Wall Street's algorithm-driven environment, it triggered a massive sell signal. Why? Because management also cut their full-year revenue guidance. They are now projecting fiscal 2026 revenue between $2.82 billion and $2.86 billion, down from the previous forecast of over $2.9 billion. When you combine a current miss with a future cut, you get the perfect storm we are witnessing right now. However, the devil is in the details, and this is where the smart friend conversation needs to happen. The primary reason for this guidance cut isn't that customers are leaving, it's that the contracts are getting more complex and, frankly, larger. Management cited revenue recognition timing due to a higher mix of deals with deferred start dates. In plain English, they have signed the deals, they have the customers, but accounting rules say they can't count the cash as revenue just yet. This is a crucial distinction that separates a dying business from a delayed one. If you are using SoFi Invest or engaging in self-investing strategies, you have to ask yourself, do I care about the accounting recognition in Q1 or do I care about the cash flow in Q3? The market, with its short attention span, hates delay. It behaves like a toddler waiting for a marshmallow. It wants the revenue now. But for those looking at Fidelity wealth management strategies or long-term investment help, this drop might look significantly different. The company's annual recurring revenue, or ARR, actually grew 18% year over year to $2.28 billion. That's the heartbeat of a subscription business, and it is still beating strong. The disconnect between that healthy ARR growth and the plummeting stock price is the tension we need to exploit. Let's step back and look at the broader landscape, because Nutanix doesn't exist in a vacuum. For the last 2 years, the biggest story in enterprise software has been the acquisition of VMware by Broadcom. That merger threw the entire IT industry into chaos, with prices hiking and support changing, leaving thousands of CIOs looking for an escape hatch. Nutanix was supposed to be that escape hatch. The expectation was that NTNX would simply open its doors and billions of dollars would flood in overnight. The reality we are seeing today is that migrating enterprise infrastructure is incredibly hard, slow, and sticky. It's not like switching from Apple stock to Microsoft. It's like replacing the foundation of a skyscraper while people are still working inside. The deals are happening. Nutanix is winning these customers, but the sales cycle is elongating because these are massive, complex architectural decisions. The drop to 48.34 USD reflects the market's frustration with the pace of this transition, not necessarily the failure of it. For the individual investor, navigating this kind of volatility requires the right tools and the right mindset. If you are trading on Interactive Brokers, you're likely seeing the borrow fees for shorting Nutanix spike as the bears pile on. The Interactive Brokers trading platform is probably lighting up with put options today. Conversely, if you are a long-term holder with Fidelity Investments, this might be the moment you look at your Fidelity mutual funds or your Fidelity IRAs and wonder if this creates a rebalancing opportunity. The behavior of retail traders versus institutional giants is fascinating here. Retail traders often panic at the headline, "revenue miss," selling their shares on Robinhood stock trading platforms or through Fidelity brokerage accounts without reading the transcript. Institutions, however, look at free cash flow, which Nutanix actually nudged higher in their outlook. That's right, despite cutting revenue guidance, they expect to generate more cash. That is a paradox that usually resolves with the stock price recovering over the medium term once the emotion washes out of the system. Now, let's talk about what Nutanix actually does, because understanding the business model is the only way to have conviction when the chart looks this ugly. Nutanix is the pioneer of hyperconverged infrastructure, or HCI. In the old days, a data center had separate silos, a rack for storage, a rack for compute or servers, and a rack for networking. It was complex, expensive, and required different teams to manage. Nutanix came along and said, why don't we squash all of that into software? They allow companies to run their data centers like public clouds, think AWS or Azure, but on their own hardware or in a hybrid environment. It's the Android of the data center world, giving you an operating system that runs anywhere. This is why they are so critical to the hybrid cloud narrative. Most big banks, governments, and healthcare providers don't want to put everything on the public cloud because of cost and security. They want a mix. Nutanix is the glue that makes that mix work. When you log into your Fidelity mobile app or check your SoFi investing dashboard, the back-end systems powering those secure financial transactions are often running on infrastructure like this. It is mission-critical stuff. You can turn the lights off in the office, but you cannot turn off the Nutanix clusters. The shift in their business model over the last few years has also been significant. They moved from selling hardware, boxes, to selling pure software subscriptions. This is why their gross margins are so high, hovering around 85–86%. Software is infinitely scalable compared to hardware. When you compare this to Tesla stock, which is burdened by the heavy costs of manufacturing physical cars, Nutanix's software model looks incredibly efficient. However,
The transition to subscription models also introduces the kind of revenue recognition noise we are hearing about today. In a subscription model, if a deal starts 1 month later than expected, that revenue vanishes from the current quarter even if the money is guaranteed. This is a crucial distinction that separates a dying business from a delayed one. If you are using SoFi Active Investing or engaging in self-investing strategies, you have to ask yourself, do I care about the accounting recognition in Q1 or do I care about the cash flow in Q3? The market, with its short attention span, hates delay. It behaves like a toddler waiting for a marshmallow. It wants the revenue now. But for those looking at Fidelity wealth management strategies or long-term investment help, this drop might look significantly different.